stock market volatility, and finally an econ map. All right, let's just jump into it. On Vaccine Tracker, as I mentioned before, it was first approved, the vaccine was first approved on December 14th. And so far, as of today, there are 87 million doses in US that have been deployed. That's 40.5, up from 29.58 per 100 people. And the estimates are still by November, excluding the variants, again, because the variants can throw this track off, all states should be vaccinated. Labor on initial claims, we're coming back a little bit better than we did before with 684,000 as of today versus about a running average 725 to 750,000 median for the last year or so. And on continual claims, we still have 18.2 million outstanding claims. All right, let's just jump into the 4 tax reduction strategies that we've been talking about. And again, I want to really focus on these things because the biggest concerns that I have is number 1, taxes. Inflation, not much of a concern anymore. I have a feeling that if you understand how inflation is going to work with the interest rates, you can mitigate the inflation because I don't anticipate it being long-term inflation. But the taxes are something that you're going to have to be prepared for. And again, we talked about last time, deduct, defer, shift, and offset. These are the 4 strategies, and most people use deduct and defer. These are the things that you could find out from TurboTax for that matter. Where the advanced tax strategies come in is in shifting and offsetting. And those are the things that you have to look for in this ever-changing tax environment. So let's take a look at what the things are that are coming up that you should be focusing on. Roth conversions, backdoor Roths. Using offsets to perform Roth conversions. That's creating deductions, whether it's charitable deductions, Section 41 deductions, conservation deductions, short-term stacking deductions. There's all kinds of different methodologies in there, but making sure that you have these strategies in place. Work on them now, please. Do not play the procrastination game and start to try to figure this out in November because that will be too late. The changes that are coming are the elimination of the 1031, increases in capital gains tax, a reduction in the estate tax limits that they have imposed now, an increase in corporate income tax, an increase in personal income tax. There's a lot of changes coming down the pike that you've got to be prepared for. Hey, before I go any further, I really want to stress again, I'm having these conversations with clients over and over again. There are, I'm going to call them snake oil salesmen, gypsies, thieves, liars, and they're out there, they're still promoting and misrepresenting indexed universal life and indexed annuities. And I get asked all the time, so Ken, sounds to me like you're really against those. And I want to be really clear, I am not. Listen, I had my own indexed annuity portfolio all the way up till 2016. I own my own indexed universal life. I am not opposed to any of these things. What I am completely opposed to is the misrepresentation that these agents, and they're still doing it. I know of a particular office right near our office in Las Vegas. These agents that call themselves fiduciaries, they pose as a fiduciary, and then they convert people as a bait and switch into IUL, indexed annuities, and REITs, and they still are earning 6 to 10% commission, still misrepresenting it. I know this because clients bring me this stuff. So all I can say to you is be careful. Do not believe what you are hearing until you see proof, and it doesn't come from the agent's mouth. It comes from deep research that you do on your own. So please do not believe this ploy that Index Universal Life can provide tax-deferred returns, and then you can take tax-free income out, and there's no consequences. There are. Don't believe the ploy that says indexed annuities provide all this income, 6% income, and then it can be passed on to other beneficiaries with no tax. None of this is true, but it is being used by these agents. And I'm actually glad what you see on the screen right now. There's major class action suits against a lot of the insurance companies to stop these practices. So this is one case where lawyers are useful to stop this kind of stuff. So inflationary risk. I don't think this is a terrible thing that's going on, because I think what's going to happen is shortly we're going to see a huge spike in inflation, But when the debt goes up and the spending goes down, that inflation will curtail itself if we follow that 1929 or 1920, the roaring 20s to the 29 crash playbook. Okay, anticipated inflation. My anticipation is 5 to 6% in 2021, 2 to 3% in 2022, but I'm still anticipating with the $1.9 trillion, the pending $3 trillion in stimulus, the pending $3 trillion in additional infrastructure spend, that we are going to see a GDP in this year, 2021, of 6 to 7%. Where do we stand? Well, when we look at these dot-com survivors, and these are the people that made it through the 1999 crash, what we have to learn from this is even though these economics are lining up to put a lot of money into the economy, it does not mean we should abandon fundamentals. Do not abandon good asset allocations strategies. And remember, asset allocation is not just having a bunch of stocks. And asset allocation is not the same as diversification. Asset allocation is using offsetting classes to reduce the amount of risk and volatility. And I'm finding a lot of people, they're trending towards Bitcoin and high tech and SPACs and just a lot of things where they're betting instead of investing. And to me, betting and gambling is a big difference between investing. Just ask Warren Buffett. Well, where do we stand? Well, right now on the S&P 500, even though we hit some peaks back there in mid-February, as of today, the S&P 500, well, the beginning of today, not the end of today, but is at 5.8% increase. If we divide that by 85 days and then annualize it, which is how we should look at everything, we're still at a 24% increase annualized on the S&P 500. That's still substantial. Where do we stand on my econ map? So if you've been following me since February of 2020 when we created this econ map, I have increased my accuracy, my original desired accuracy. I said, if I come in at 70% accuracy, I'll be happy. Right around the end of the year, I was up at about 80% accuracy. As of right now, I'm at about 90% accuracy. Now, that may or may not continue, but this econ map that I've built out, again, is not, I wish I could take credit for figuring these things out. This was taught to me by the first firm that I worked for. But we are still anticipating a major real estate crash sometimes towards November, December, maybe the highest in January, February. But again, a lot of that is going to depend upon the forbearance and what the government does. Are they going to forgive it? Are they going to delay it? Or are they going to hold the forbearances to the fire, right? So a lot of that is that timing. I will adjust that timing as I get more information from the government, but also as it pertains to unemployment too. So we have this circle of opportunity somewhere towards the end of 2021 to the beginning of 2022 for real estate. But a lot of the stock market is also going to be conditioned upon taxes and this stimulus. I do think the stock market has another 10% built into it. Doesn't mean that you should wait for that other 10%. We will start looking to pare back some of the asset allocation that we have when we hit about another 5% up, and we have some timing issues on that. But again, right now, I think that the actions are that you should take is, number one, change your portfolio to adjust to where people are spending money now. Continue to refinance and get those rates down. Cash up. Now, when I say cash up, let me explain what I mean by that. I do not mean, by any means, holding money in cash. You know, I get a lot of people, they'll say, well, I'm worried about the stock market. You're worried about the potential for volatility, right? So if I put money into a stock and I'm worried that it's going to drop 10%, whatever it is, right? But if I offset that with some type of asset allocation where I've got an opposing investment that can offset that or help hold that back, that loss back, I have some mitigated risk. But I have the opportunity for loss. I don't have the guaranteed loss. However, many people are misinterpreting what I'm saying about cashing up for real estate. I'm not saying hold cash. That is the most insane thing in the world. Think about it. If we do have 5% inflation and you hold cash at a bank account for 0.5%, 1%, waiting for a real estate crash, what happens if the real estate crash never comes? Then you're sitting there, you take a guaranteed loss versus a potential loss in the stock market. Because if you're earning 0.5% and inflation's 5%, you lost 4.5%. That's a guaranteed loss that's not recoverable, right? Because you physically lost the purchasing power of that money. What I'm talking about is being ready. Have a home equity line of credit. Have a loan ability on your investments. Have loan abilities on your retirement plans. Don't leave the money sitting there idle doing nothing, because if the stock market does go up by another 10% by the time that the real estate crashes into early of next year, you could be hedging on that money, making an extra 5 or 10%, and then still have the ability to borrow out to buy real estate and hedge back on that stock. So what I'm saying is make it available. Do not leave it in cash. I need clarification because I'm seeing a whole bunch of cash being parked away. Consider TIPS to offset the inflation. Instead of bonds, consider the Treasury inflation protected securities. Again, consider reverse mortgages. This is another way that you can cash up. I'm not saying take the money out of the reverse mortgage right now. I'm saying get it approved. Have it ready, because you don't want to take it out because you'll pay interest on it if you take it out. Consider reducing, if you do have any kind of bond exposure, reduce that down as much as you can to short to intermediate term durations. And definitely, please start tax harvesting. And also look for you've heard the term dollar cost averaging. When I buy investments, I want a dollar cost average in to reduce the timing risk. It's no different. It's what we did last year. We dollar cost averaged in. But reverse dollar cost averaging also works the same way. When we see something where the market is going up, but we want to take some of that risk back, we don't just sell it. I love people when they say, well, when it gets to the top, sell it. Tell me when that is, and why haven't you done that in the past? Because you think it's going to continue up. Or people will say, well, listen, when the market drops, buy it. At what percentage and when? And what most people do when the market drops is they don't buy. They get scared. They think when the market drops, it's going to keep dropping, and they don't do anything. So that mentality or strategy never works, never will work. Stop doing that, please. So, summary opinion, I'm going to give you an outcome here. Be careful of the new fraud. This is people that are taking advantage of people's fears. And I'm not saying IUL is bad. I'm saying watch out for all this misrepresentation and the agents showing you things that are not repeatable or possible in the future. Listen, I keep telling people this is just a repeat of history. I've been doing this almost 40 years. When I got into the industry, people were complaining that whole life was being sold as retirement plans. And there was all kinds of class action suits. Boom, that went away for a while. Then Universal Life came out. They were selling that like hotcakes because they were showing 10 and 12% rate of returns. But when the returns came down, there's an internal foreclosure on that policy, which creates a taxable event. Boom, that went out of business and all kinds of class action suits. Then in the mid-90s, Variable Life came out. And all the agents and companies were selling this stuff, misrepresenting it, because they were saying you could make tax-deferred returns with no risk, it's less cost. But then when the returns couldn't support the cost of insurance, there was an internal foreclosure. And guess what? That went out of business, all kinds of class action suits. And voila, what is the flavor of this decade? Index Universal Life. It's no different. The class action suits are starting. Be careful of those people who are calling themselves fiduciaries and then just switch you into, here's my Index Universal Life, here's my indexed annuity, here's my REIT, my private issued REIT. They're using the front as a fiduciary to convert you into a product sale. Please be careful that I'm seeing this huge uptrend. However, if you watched me since March of last year, I predicted this. In every kind of recession, any kind of event, like I saw in the mid-'80s, I saw it in the tech crash, I saw it in 9/11, I saw it in the real estate crash. These kinds of snake oil salespeople come out of the woodwork and take advantage of people's unknowing, fears, and the complexity of what they're actually selling. The other thing is same thing with crypto, gold. These things are no different. Please do not go out and buy individual crypto. There are ETFs that offer them, but again, you should never have more than 2% in your total allocation, and look at that as a gamble account. That is not an investing account, because investing is defined as something that can create income. Crypto is valued in the same way that gold is. Emotion, supply, and demand. And that is all unpredictable versus a item that can be sold. I'm going to go to a company that sells toilet paper. I know people are going to always need toilet paper. There's a repeatable thing. The only difference that's going to throw that off is price of oil, price of commodity, price of wood, whatever the supply is. But it's definable within volatility as far as I see it. And then focus on the new tax rules. These are the new RMD rules, the Secure Act rules, and finally the IRA rules. Hey, with that in mind, before I wrap up today, if you haven't joined my YouTube channel, You just Google it. It's just Ken Himmler on YouTube, or you can H&H Retirement on YouTube. I've got it populated in a couple different streams, but you can just click on the red button that you see there on your right hand side. You can subscribe, and then you'll get notices. You can also go to our web page and just go to events, and you can see a live stream or a repeat of these broadcasts, and that's just hhrdm.com. Again, it's hhrdm.com. And finally, before I wrap it up for today, if you have any questions, give our office a call. It's 844-702-1040. Again, 844-702-1040. With that in mind,